Lovely.
All right, so we're live. We're back with Hamish, Peter, and Ben. We thought we might, as always, get the most exciting part of the presentation out to begin with. Hamish, let's do this disclaimer, mate, before we jump into some of the exciting stuff.
Great. Hopefully, you can see that. Can you see that there, Jay?
Yeah, just maybe.
Yeah, great. So yeah, as we always say, just to bear in mind that anything we talk about here is general in nature, and we haven't considered your personal financial circumstances. But with that, I'll hand back to you, Jay. Let me just get rid of my.
Thanks, Hamish. Yeah, and just off air, we have a little bit of a chat before we get on board, and we're just having a chat about some of the news of the day. And Peter, I pulled Peter up just beforehand and said, save that for our discussion. Peter, you started talking about the issue with Virgin going into administration overnight, and do you want to maybe ask that question of Hamish while we're on air?
I suppose, Hamish, if you could, just for our benefit as advisors, but also broadly for our client base, can you just give us some feedback on why you wouldn't have chosen Virgin as a share to put into our portfolio? And with the falling over of Virgin, the thought is that maybe Qantas are going to have massive market share, but that's going to be a little while away. So perhaps just if you could just give us an overview of the Virgin situation and how that might flow through to Qantas, and when Qantas might be a good option, perhaps, if you could give us something on that, please.
Yeah, great. No, I think it's a really good point, and it sort of goes to the heart of how we construct portfolios. So what we're trying to do is build long-term portfolios. So we want to own a group of businesses that we feel are genuinely high-quality businesses that we can own for the long term. In addition to that, we also want to be diversified. So, for instance, there's no point in just owning 4 banks. We want to own businesses in different industries. Specifically with Virgin and the airlines in general, historically it's been a very cyclical and very competitive industry. And so if you're looking at things from a shorter term perspective, there might be trading opportunities, but that's not really what we're trying to do with your portfolios. I think a great thing, I remember when I first in the industry around sort of 2000, I remember speaking to sort of one of my mentors about Qantas, because Qantas had just fallen. It had probably fallen about 30 or 40%. And I said to him, this must be a great buy, a great blue chip company. It's really cheap. And he sort of, started preaching to me how, the challenges within the industry and everything like that. And, Qantas has been up and down over the years. But funnily enough, the share price, if I bring up, let me just share this with you. Can you see that chart there now? Yep. So this is a chart of Qantas going back to kind of the early 2000s when I first started in the industry. It's basically the same price as what it was back then. So that's sort of that's kind of indicative of a business that's not generating strong returns over the long term. So I've had a number of people ask me about, obviously Qantas you would think is going to be a beneficiary of this situation, and to use the expression of buying straw hats in winter, Qantas I'm sure will prove to be a very cheap buy at this point. But also I think it's important to keep in mind that it's probably not a core long-term business to own for the long term. So if somebody wanted to have a flutter and take a 2-year view, it may be okay, but for us, we would prefer to try and own quality businesses that we want to own regardless of the short-term outlook.
Right, and Virgin, sort of like the extension of that is that Virgin's had much more volatility and much less stability even than Qantas have. So you wouldn't have gone near that in the past, which is why we don't own it. We're not in the shit now. Excuse me.
That's exactly right. Like I think if you had to own an airline, you would own Qantas, and otherwise just stay well away.
With Virgin, one of the key things I think you've mentioned for many purchases we've done is that Virgin had a lot of debt, underlying debt, and that's always a big warning sign for anything we're looking to go into.
That's exactly right. Exactly right, Ben. And I think generally, we're trying to own businesses with solid balance sheets, and so that they can ride out this volatility and ultimately try and use that to their advantage. And by and large, like if you look at, balance sheets of things like Wesfarmers and Brambles, and these, Brambles is still buying back shares today in the current environment. Now, there's a couple like Transurban, the infrastructure stocks that we own for you, Transurban, Atlas Arteria, those types of businesses have more gearing, but they have more.
I think we might have
just lost you a little bit,
Hamish.
Frozen.
I might mime while Hamish is there. Yeah, I think to Hamish's point as he started, hopefully he gets back on, but the key of actually owning well capitalized, largely he's back. Started talking for you, Hamish. It was dangerous.
We lost you for a moment or two, mate.
Don't get me started on NBN. But so I was just sort of saying, generally businesses we own have very good balance sheets. The one exception would be, the Transurbans and Atlas Arterias tend to be more highly geared, but that's somewhat offset by really defensive and predictable revenue streams.
That's probably a reasonable segue, Hamish, into sort of the portfolio, the Sarto portfolio, and some of the sort of specific stock selections. So maybe what are some of the things that you're looking at in terms of adding to in the portfolio, either topping up existing holdings or new additions to the portfolio based upon the current environment?
So I think one of the first things I'd say is in an environment like this, I think it just highlights the benefits of diversification. So, for me, it's about making sure that a portfolio is not too exposed in one particular area. But I mean, within the portfolios that we own, I guess it's part of the process, and we're sort of fortunate in times like this that a big component of the portfolio is these very defensive type of businesses. So again, we continue to be really comfortable with those. So examples there are Sonic Healthcare, Medibank in the healthcare industry, their services will continue to be in demand. We've got things like Amcor and Brambles, which are essentially providing services around, everyday needs, food, packaging, that sort of stuff. Something like Transurban and Atlas Arteria toll roads would typically be very defensive. Now, there are some pressures there at the moment, but if we can think longer term, those businesses will continue to be in demand. So Wesfarmers is another example. I think out of all of Wesfarmers' biggest asset is Bunnings, and one would think that ultimately Bunnings will come through this stronger than ever. So that they would be some examples there. They're sort of those defensive businesses that are sort of less affected by what we're going through today. On the other side of it, then we've got something like the banks, where clearly they will experience pressures from this. Now, there are some risks around the banks, but in addition to that, their share prices have really come down a lot now. So again, for somebody that has very little exposure to the banks, that now might be a sensible time to have a little bit more exposure to the banks. CBA is sort of the highest quality bank, but basically we like all of the major four so long as they are sized accordingly within portfolios. In addition to that, I know a lot of your clients own the future generation companies, and we continue to really like those. I'll just show you something really quickly. if we look at the returns of Future Generation Global, so they just released their March result. Let me just bring this up. My apologies. Okay. This is the Future Generation Global portfolio. So their portfolio only fell about 8% for the month of March.
Do you mind making it a little bit bigger if that's okay? Can you zoom in? That's okay? Yep, beautiful. Thanks.
So you can see their portfolio fell only about 8% for the month of March, which was quite incredible. What's probably more impressive, over a 12-month period, the portfolio is actually up 7%. That's what the underlying portfolio is doing. Now, the share price, being a listed investment company, the share price can deviate from what the underlying portfolio is doing. So the share price.
No
NBN.
He always freezes with his mouth open as well.
Bad timing.
Over to you, PB.
Perhaps while we're waiting for Hamish to come back, the conversation, I think
like Future Generation.
Gotcha. It's coming back in and out spasmodically, Hamish.
We've done well to get to week 3 without any tech difficulties.
There we are. We got you again. I can see your eyes moving now.
I'm having to toggle between my phone and my and my broadband. So anyway, sorry.
We lost you when you started talking about the asset backing the share price. The assets backing the share price.
Got it. Okay. Yeah. So basically, over the last 12 months, the underlying assets of Future Generation Global have grown by 7%, but the share price has actually fallen. What that means is that the shares look very cheap relative to the underlying portfolio. So just to show up, this is the share price of Future Generation Global going back, so what's that, early 2000s there. So the share price has sort of fallen from about $1.35 down to about $1.11 over this period, but the actual assets have actually gone up. So what all that means is that the share price has become very cheap relative to net assets, but the underlying portfolio is absolutely doing what we would expect it to do in this environment.
Essentially, it's like, I think we've spoken about this simply, is you're paying $1.11 for $1.30 worth of assets. So looking at it in that sense is you're buying something that's on sale.
Absolutely. You're actually buying $1.40 of assets for $1.11.
Yeah.
It's a hell of a good discount to be buying. Better you're buying on Boxing Day rather than Christmas Eve.
That's exactly right. Exactly right.
Jay, probably at risk of going down a big rabbit hole here and turning this into a marathon, do we want to touch on oil just briefly?
Yeah, so I'm mindful of that. So talking about the things that are topical at the moment, obviously market took a little bit of a spit downwards yesterday. I think it may have been in light of some news around oil prices. Maybe you want to touch on that, Ben?
Yeah.
I suppose just probably deferring to Hamish mainly is I don't think directly our portfolios have an exposure to oil in many cases at all. But as we know, when the entire market gets a little bit of a stumble, we will all sort of feel a little bit of that pain. So I suppose, and we've just spoken about why we don't probably own companies that are volatile, and the oil market is really just volatility, isn't it? So we're not really directly exposed to it, but people were likely to see the market come back a little bit in some of their portfolios slip maybe today and yesterday obviously already a little bit. So can you just touch on that, how the oil market impacts us even if we're not directly invested into it?
For sure, yeah, no, great point. So just quickly, I guess the more specific exposures would be Origin Energy. Now, Origin is a little bit different in that it has a utility business, essentially generating and retailing electricity, which is very, very defensive. But more recently, it now sells LNG, which is linked to oil prices. So it has one really defensive business, and then it has one business that is linked to what oil prices are doing. So that's why you're seeing the volatility in Origin Energy at the moment. In short, though, basically, investors are paying today for the defensive business, and they get the oil business thrown in for free, which makes Origin seem cheap. Woodside, which we also have a little bit of exposure to with portfolios, is also in the business of selling LNG, but it has sort of some of the highest quality assets in the world in that regard. Just with the oil price, I'm no expert on oil, but my understanding of this is you would have seen that the May futures contract went negative, which in simple terms basically means that if somebody owns a contract, which means that they have to take delivery of oil, they need to store that oil somewhere, and all of the storage for oil has now been taken up. So basically, people are selling these contracts at a negative price to avoid having to take
delivery
of the contract. Now, that can all sound complicated. At the end of the day, I think the way to think about oil is you've got the Saudis and Russia that are in a fight and have both increased production, for this fight. The reality is that the Saudis, their financial position cannot tolerate an oil price at this level because their government debt is exploding under this scenario. In addition to that, you're not seeing any investment in new production of oil because obviously nobody will be making money investing in new production at these levels. So what happens because of this is that new supply dries up, and eventually when demand sort of comes back to some sort of normal level, then you would expect that prices ultimately rise. And then what that means specifically for your portfolios, in particular, if we look at Origin Energy, which basically you're simply just buying the defensive utility business and you have a free option on the oil price going up in the future, that means that Origin is sort of heavily discounted, and if oil prices do return to more normal levels, there will be a very good upside there.
So just a quick question, with a few of the portfolios Hamish have been recommending getting out of, such as AGL, for that particular reason, if we already hold Origin, that's probably enough.
Correct, exactly right. And basically AGL sort of has the more utility side of the business without the oil volatility there, but Origin has the upside if the oil price bounces back. So basically we would prefer to not own AGL and Origin. We'd rather just own Origin and use that AGL money to try and diversify into other areas.
Good, thank you.
All right, well, I think we've done a pretty good job with some technical difficulties. I think your closing recommendation is a no to the NBN.
That's it.
All right, well, again, mate, thank you for the update. I know we certainly appreciate it, as do all the Burke Britton and Secure Life clients. Oh, there we go. It's time to get to work. So thanks again, and we'll see you again next week.